confusion, and that's very understandable. A year ago, it was clear that the market reacted to the pandemic and that the money was going to come in and it would support the economy no matter what. Now, here we are a year later. A lot of that money came in with the last round of the stimulus coming in more recently. But the situation has changed because nobody really knows just how far the economic recovery can go, especially at this point where you have Powell saying on one hand, we're looking at a big surge in growth for 2021, but then we're looking at a decline in 2022 in terms of GDP. And then he comes out and says that the recovery is far from complete. So there's one side of that conversation. And then you had the Yellen side of the conversation, which says that she expects full employment by in a year from now. So I think people are just really grasping at straws here. And when the smartest people in the room are grasping at straws, it makes it really dicey for us traders. And that's why this is probably a really good time to stand back a little bit and see what actually dominates the market sentiment here, bearish or bullish, because you can make a case for both right now. A lot of it had to do with foreign buying and the scarcity of buyers, which is why the yields went up, especially last week when the conversation from the Fed was, even though they'd be accommodative, they were looking like very bullish for inflation and bullish for economic growth, which of course then means that it's not as attractive to buy the 10-year bonds at that particular price, because those bonds really are more attractive, obviously, when they're more at face value than, let's say, buying equities. But once equities become more exciting, then the yields will start to go up as the TLTs, in particular, the 20-plus year bonds, go down. So what was interesting is that you had all this talk about inflation, but all of these big inflationary indicators have also come down a little bit, even though the yields have relaxed. So the relationships are a little bit mixed up here, and I would imagine at some point will settle. So just looking at the yields alone, to try to get rid of all the noise, there's a couple of things I like to look at. One, and I know that, Jackie, we've talked about this before, is the junk bonds, because the Fed is still continuing to buy $120 billion worth of Treasury debt and mortgage-backed securities every month. That's what Powell said today. So the junk bonds would be a good place to look to see what risk on is like. It's in a caution phase right now, which means it's trading under the 50-day moving average, but yet it's holding a longer-term moving average. If that starts to fail, I think that would be the writing on the wall. If it holds, good sign. Also, you want to take a look at those TLTs, those 20-plus years, because that came all the way down to a major support level at 133. They're now trading closer to 137. We've seen a bounce. Is it a bounce meaning worst is over, or is it just a short covering bounce because it got a little bit oversold? Don't know. This is what's making it really tough. People are all negative gold, but yet at the same time, the dollar has gone up while the yields have softened. But if there's going to be any kind of real inflation, which right now people are doubting because Europe is closed, I mean, you see, as you keep talking, you can get yourself nuts. So, so basically the best thing to do right here, I'd say, is try to analyze all you want. Yields up, yields down. Dollar up, dollar down, gold up, gold down, market up, market down. But really, as a trader, make sure you're clear on what you want to do and where you want to go. And cash is okay, too, right now. We can basically talk from our own personal experience. So we had an incredible run all throughout, basically from the year anniversary in March. We started buying instruments then, particularly buying gold at that point. And we really had a great run through January and February. And since March has begun, things have gotten choppier. So a lot of our long-term positions we've already gotten out of, or we've taken profits. Things that we've put on more recently, you have two choices right here. If you have a vision of something that you think is going to be strong, let's say, for example, your vision is in big tech right now, because obviously that's been beat up and now coming back. You have to do it two ways. You either have to use these recent lows and play very small positions and get out if it breaks those recent lows, or you have to have a big vision Like somebody like Kathy Wood, who thinks Tesla's going to 3,000. Meanwhile, Tesla now is trading at around $660, and she keeps buying on the way down because she's not interested in that. To her, it's the long-range vision. I'd like to speak to the former, not the latter, because we're in a game here where we're trying to make money and protect our assets. We're not looking to sit through deep corrections. So that's what I would do. I'd make sure you understood your time frame. Well, I take all these predictions basically with a grain of salt, because you can find somebody who says what he said, Mr. Lee, and then you can find other people that are talking about $400,000 Bitcoin and that this is the dip and it's not going to go much lower. So basically what I think is this: we were in instruments related to cryptocurrencies like MicroStrategy and Riot and Canaan, and for a while there, the Grayscale GBTC. And now we're out of all of that. And so, again, to me, I would rather wait for the evidence that it's going to go down another 90%. Or it's going to go up another 300%. It's sitting right here at 55,000. So we already know that 50,000 has been a really good support level. And then the last time it went up to 60, it came down to 53. Then it went back up to 60, it came down to 55, where it's sitting right now. So you're getting these sort of higher lows every time it dips. So it's okay to be a bit patient again and see if it can hold here at 55. Great. Maybe that means that Mr. Lee is completely wrong and this is just a healthy correction of liquidation, as other things have been very choppy. Or if it breaks 55, then you have to see what happens to 50. If it breaks down under 50, yeah, you probably should sit aside and wait for some kind of a level of support to be determined, and also wait for some other new news to come out. Right now, all the news is in the market about the institutional buying. It's funny because Morgan Stanley said, oh, we're going to let our high net worth clients buy a percentage of cryptocurrencies in their accounts, and that kind of almost was the top. So I think long term, you've got to say that Bitcoin and blockchain technology, Ethereum, long term bullish. But again, it's just like the market. There's the prediction, and then there's the trading strategy. The digital currency that's created by the central banks is still a regulated currency that can be manipulated by the central banks. Whereas the whole idea of cryptocurrency is for no regulation and for it to be more autonomous and to be trading more based on whatever their version is of fair market value. So I don't know if a digital currency, it may take some of the thunder away from Bitcoin in a sense. I know China's been trying to do that as well. But as far as the actual philosophy of Bitcoin and what it means, or in all the other alternative coins that have come out, I believe that as the government tries to steal some of the thunder, there's so much innovation in that space that the young people that are working on all of this technology will find their ways to work around whatever the Treasury decides to do. So I didn't find, other than a temporary pressure that it put on the alternative currency market and a boost to the dollar right here, I didn't take those words to be any kind of great message from this master that he really knows what's going to happen over the next 5 to 10 years.